Interest rates have had a major impact on commercial and industrial real estate values, and I have a chart to share with you that shows to what extent. The chart essentially shows the cap rates needed in order to meet debt service coverage ratios set by a lender. There are a few things to unpack there, but if you just want the chart, I've put a link to download it for free in the description. The spreadsheet allows you to change both the DSCR and the amortization period. We're going to do a deep dive into the chart, but first a little bit about me. I've worked as an industrial real estate broker since 2005 and started buying properties myself in 2014. I probably have an unhealthy obsession with industrial real estate, or at least an unrecommended portfolio of it, as the vast majority of my net worth is directly invested in it. Oh, and I make a ton of videos on the topic and pretty much think about it nonstop. But let's get to the chart. This row shows the different loan to values ranging from 50% to 100%, and this column shows the interest rates from 0% to 10%. Everything inside this table shows the corresponding cap rate needed to cover the debt service ratio with this length of amortization up. You can download this for free, as I mentioned, and you can change these two numbers to whatever you like. The formula I used to make these calculations is more complex than it needs to be, but it really helps conceptualize what's happening. First, the DSCR calculation is net operating income divided by annual debt service. If we change around the order of that formula, we get annual debt service equals net operating income divided by DSCR, and sometimes, by the way, might just be called debt coverage ratio. I put in an arbitrary $100,000 for the net operating income, but that's really just a placeholder. This chart wouldn't make any difference if that number was $1 or $1 billion. It really just helps to visualize this math a bit easier. But now we can take the cap rate formula, which is net operating income divided by value. And again, that's what this whole chart is trying to solve. What cap rate is required to meet the DSCR? So we know NOI, it's this arbitrary number right up here. So the only thing we need now to figure out is the value, and we have enough information here to answer that. I don't intend for this to get too complex, but we just need to do a present value calculation to come up with that figure. Here's the interest rate, which we need to divide by 12. Here's our amortization, which we need to multiply by 12. And really the only additional calculation we need is to calculate the payment, which again, we have all the info that we need. Going back to the debt service coverage ratio, remember that's the amount of cash flow needed for every $1 of debt. So if we rearrange that formula, we could then take NOI and divide it by DSCR to get that annual debt service. That calculation gives the amount of debt the property could support annually. So if we divide it by 12, we have the monthly amount, and then we could divide it by the loan to value, and we could get the monthly payments. This present value calculation gives us value such that we can now find out the cap rate by simply dividing net operating income by the value. The real magic of this chart is we can see what's happening to the market as interest rates have increased. All things being equal, and let's just assume a 70% loan to value for a moment, when interest rates were 3%, a 5.8% cap rate would meet the DSCR requirements. But let's now say that interest rates are 7%, which would mean the cap rate needs to be 8.1%. This means one of two things for an investor looking to buy a property. First, the price will need to be lowered, or second, the amount of down payment needs to be increased. Neither of these two scenarios tend to be attractive, and it's the main reason deal volume has fallen so much. Some investors are still trying to be creative, such as finding ways to increase NOI or to get sellers to do vendor financing, but it's still a stark difference from the early 2022 market. So transaction volumes have declined, but what happens for an investor that has a mortgage coming up for renewal? Will lenders start requiring investors to bring the DSCR in line with their requirements? And if so, does that mean that investors might have to do cash-in refinancing? A lot of people thought there would be rate cuts this year, and it's not unreasonable to expect that as the Fed's hinted that there could be a few, but rates have actually remained stable and some believe we might even be headed for another increase. In reality, nobody actually knows where they're headed, so instead of trying to predict the future, let's just deal with where we're at right now. It might require some tough decisions, but when or if rates were to drop again, there could be some real positive upside. So I'll turn it to you. What do you think about all this? Are you bullish, bearish, or neutral on where the commercial industrial real estate markets sit right now? I'd love to hear from you. Leave me a comment below.